Hello and welcome to Sprott Radio. I'm your host, Ed Coyne, Senior Managing Partner at Sprott. Pleased today to have our CEO of Sprott Asset Management, John Ciampaglia, join us to wrap up 2025 in the world of nuclear. John, last time we talked back in September, you were just coming back from the World Nuclear Symposium, and there seemed to be a lot of excitement around that. Since then, a whole lot really hasn't happened from a price standpoint. Maybe let's go back to that first, and then we'll go forward of what may be happening in the future.
Yeah, thanks, Ed. Good to be back. Yeah, I mean, there was a lot of excitement coming out of WNA, and I think that was largely on the back of two things. One, the association put out its biennial supply demand forecast, and that showed much more robust growth for uranium going out to the year 2040. And that's, I think, well understood. There's pretty active programs that are in place, and new programs are being announced all the time in terms of financial support and signaling more capacity. But those don't impact the market today. Those obviously are long dated projects. They don't translate in uranium demand in the very near term, but they will obviously lead to greater demand down the road. At some point, we hit a bit of an air pocket, and I think part of it was not related to uranium or nuclear energy whatsoever. And I think that's the thing that's created the disconnect where the fundamentals, the announcements for nuclear and uranium have been very, very constructive, but the stocks and the price of uranium have been kind of subject to volatility across, I think, a greater risk-off environment that we saw in the back half of October and November was a very challenging month for a lot of different commodity sectors. There's obviously some anxiety starting to build with respect to the pace of these AI data center build-outs and whether there is going to be missed targets, in terms of some of these very aggressive expectations. So, we kind of take a step back and say, from the perspective of the spot price in uranium, it was kind of a lost year. That's why I'm kind of thinking about it, in that the price was very range bound. We started the year around $70. We got to a low of 63 around Liberation Day. We rallied up to 83, and right now we're sitting with a very wide bid ask of 77 to $80. So, it's been kind of a nothing year, even though the backdrop has been really, really bullish in terms of announcements. The stocks, on the other hand, have fared better. And the stocks, I think, are obviously being driven by more investors. And they are, obviously looking at the fundamentals in the future. And they're weighing the prospects of the industry given the structural supply deficit. And they're bidding those stocks up. So we've seen uranium stocks up, on average around 40% for the year, even though the commodity price has been rather muted. So I think the commodity price has been held back because of a lack of contracting by utilities, a lack of buying in the spot market. There's this real disconnect between what's happening in the physical market versus what's happening with the equities, which I think are more forward driven.
Well, that's an interesting point because many of our listeners know us through the gold and silver side of the market, and it was really for the last decade or so it's been the opposite, where the physical market's done quite well and the miners have lagged. I find it interesting that on the uranium front, just the opposite has happened. As you mentioned, physical uranium has been basically flattened. Do you think it's a more sophisticated market or a more informed market when you're looking at uranium today and uranium mining stocks and investors willing to look forward and saying, hey, we know this is coming, so let's start getting an allocation to the miners today? Why do you think that disconnect is there with what's happening in the uranium market versus say gold and silver, as far as how the mining stocks perform relative to the physical itself?
Yeah, I mean, there's clearly periods where they kind of disconnect from each other. There was a period in, say, 2021 where the stocks got way ahead of themselves, and then for about 2 years, the physical metal outperformed the equities, and then that leadership about a year and a half ago changed hands once again. So I think that's one of the reasons why most investors tend to own some proportion of their allocation in physical and some in the equities, because it's very difficult to time which group is going to perform when. And I think it's a good kind of risk mitigation strategy to have some proportion of both. But I think that the big takeaway from 2025 is the disconnect between, let's call them end users of uranium, i.e., the utilities, and financial investors in uranium. Very different behavior. So if you think about the investors, they've allocated a lot of capital to the space this year. There has been a lot of equity issuance, there's been a lot of convertible debt issuance. And then you contrast that to the physical market where utilities are playing, which is the term market. And for the first 10 months of the year, I think it's fair to say that activity in the term market was anemic. It was essentially dead because utilities just didn't seem to want to pull the trigger and enter into new contracts with so many what if scenarios, I think taking all the oxygen out of the room, which were related to, will there be tariffs on uranium and other parts of the fuel bundle cycle? Will there be trade restrictions? Will there be export taxes? What about the Section 232 review that is currently underway for uranium? What impact could that have? What about this idea that the US should resume building a strategic uranium reserve? That was a topic that came out of nowhere in September by the US Department of Energy Secretary, which really got the market kind of questioning, okay, what if the government steps in? Could they start buying uranium? Could they create a price floor for the metal for US domestic production? And people are trying to connect the dots here because there's some very unconventional and I'd say very aggressive energy policy coming out of the US where they are making equity investments in mining companies. They are providing substantial loans. They are engaging in offtake agreements for future production. They are basically doing a lot of very unconventional tactics to reshore these critical supply chains. And so the question I think that a lot of investors have is, will uranium be the next metal where the government becomes, in the US, a lot more active? And could they have an impact on the market? And from
Hmm.
talking to different market participants, the interesting thing is nobody welcomes this intervention. The utilities don't want the government stepping in. And the thought here is that they are ultimately going to push the price up and force utilities to pay higher prices in the future. Even some of the key producers don't want the government to come in and meddle in their market. So it's going to be, I think, a 2026 item to look for is what other policy. Now, I think you have to sit back and say, what are they ultimately trying to do? What they're trying to do is mitigate against supply chain risks, particularly from countries that are friendly today, but may not be the next day. And the US is obviously hugely dependent on other countries for all of its uranium. And yes, the uranium sector in the United States is slowly coming back to life after basically being 100% shut in. But there's still a massive gap between annual requirements in the United States and annual production. And that delta is somewhere in the range of 46 or 47 million pounds per year. And so it's a big problem to solve for. And I don't think it's going to be done overnight, but it's something we're looking for. We could definitely envision announcements that are very aggressive in terms of this reshoring and restocking idea of uranium, which, in prior cycles, the government has historically held, stockpiles of a lot of different critical materials, including uranium. So that's one item we're going to wait and see how that plays out.
I think it's interesting the way the market's playing this out because there's an assumption that there's just stockpiles out there and it's just deciding who wants it and when. When in reality, we're seeing more and more supply deficits happen, even with existing producers out there. Some of the largest producers out there, I saw earlier this year, they were having challenges continuing to operate at the same level and certainly having difficulty trying to ramp up their production. Any color on that, talking about supply and deficits, what's that looking like and how that will most likely impact prices longer term as well. Any color you can give on that?
Yeah, I mean, I just came from two bank-sponsored uranium mining conferences in the last few weeks. And so I got to sit on panels with uranium producers, and the messaging is very clear. There is clearly a stalemate going on between the two parties. I mentioned the contracting has been anemic for the last 10 months of the year. In the last 4 or 5 weeks, we've seen a little bit of a green shoot appear where contracting volumes have picked up. But clearly, there's kind of a disconnect here where utilities have to buy, producers don't want to sell at prices that are too low. And I would say that there's been a good stalemate here, and it's one of the reasons why we haven't had a lot of contracting volume. Why contracting volume is important is it sends signals to investors, and without those signals, I think a lot of people have to kind of look beyond. And I think the reason why investors are attracted to uranium is because these utilities can delay and defer as long as they can, but ultimately they're gonna have to pay up and buy. And so while there hasn't been much demand this year in terms of contractual renewals, obviously that's just going to get punted into the future. And I like to put this into context for people. So last year, the industry signed 110 million pounds of contracts for future delivery. Up until October, we were only at 48 million pounds for the year. In November, we saw a big spike, and we're right now sitting around 82 million pounds for the year. So we'll see what happens in the last week or two of the year, but fair to say that we're going to be below last year's number. What's more important is that the industry uses this theoretical benchmark of 150 million pounds as the number whereby it replaces what it consumes. That's not the actual production, but it's a contracting rate that they think approximates replacement rate contracting. So the 150, we're a far cry from that this year, last year. And so we haven't really got into this cycle of replacing what we've consumed because utilities have basically been delaying purchasing new purchases for future delivery and obviously been comfortable working down their legacy inventories and legacy contracts. At some point, there has to be an acceleration of contracting because the industry stats clearly signal that there are billions of pounds of uranium that have to be contracted
Hmm.
for purchase in the next few years. And that's the big challenge. Now, the industry, meaning the utilities, are all very confident that a lot of new supply is going to come to market in time for when they need those pounds. But as you and I know, working at Sprott for as long as we have, mining is not easy, particularly uranium mining. And we've seen just about every brownfield, meaning an existing mine that was put on care and maintenance, turned back on, has had growing pains. We also have the two largest producers in the world. They've had some production issues, but they've also, I think more importantly, signaled to the market that they're not interested in selling uranium at low prices anymore. They are holding, I think, much more negotiating leverage than they've ever had. And this is why I use this word stalemate, that, who's going to blink? And so far, the key producers are really dug into this supply discipline strategy where it's value over volume.
Correct me if I'm wrong with this, but I think the cost of uranium into the overall operating budget of a reactor is like 5%, 7%. So if that price even doubles, it's a relatively small amount of the overall cost of running that reactor. Is that maybe part of it? They don't care if, hey, it's going to stay around 60, $70, $80 a pound for now. And if it goes to 110, so be it. But let's just wait and see kind of who blinks first on that. Is that kind of happening? Or, as you talk to more of these companies out there, is that sort of the way this business operates? Or is this something new that we're identifying as we get deeper into this market?
Yeah, I mean, the number one job for a utility is never to be caught short fuel. And they are very good at managing the supply chain with very long lead times and purchase agreements to ensure that never happens. So this is not, like the natural gas market where there's a shock, there's a disruption, and the price spikes. So it's a very different market. But having said that, utilities are making record prices for electricity. Their customers are clamoring for more electricity. As you mentioned, a lot of that is AI driven data centers, but they have not had to deal with this load growth before. And you're starting to see some of these tech companies take matters into their own hands.
Hmm.
They're signing deals with startup companies, existing companies, incumbent utilities to ensure they've got enough electricity, which is becoming, I think, one of the key bottlenecks that the investment community is recognizing. in terms of the, these very grand ambitions to build out a lot of AI data center capacity. Electricity is going to, I think, be a key issue going forward. And you're starting to see some of the conflicts arise between ratepayers and large industrial users like hyperscalers. There's clearly pressure on the electricity price as new entrants come in and demand and secure more and more energy for themselves. So it is going to be an interesting dynamic for sure going forward.
Well, it's interesting if you're paying attention, you see more and more, albeit sporadically, news articles and TV interviews coming out about people's utility bills going up. And I do think that the AI and data center world is going to be running up against a PR problem that they're taking all the electricity, and there will be a coming to roost sort of moment where they have to justify, hey, we're going to continue to grow this AI data and other things out there. And yes, we're going to be competing for your energy. And so, yes, the price is going to go higher. It feels like nuclear is kind of at the front end of that. They're the one that's going to solve that. They're going to the one that's going to be able to produce that 24/7 baseload energy. What do you think it will take for the world to wake up and say, you know what? In 5 years, we don't have enough. We need more. This price has to go higher to incentivize both the existing mines, but also to put capital into new mines to come online. What are some of the things that will need to happen for that to really start to move this price?
Well, I think the utilities are single-handedly betting that some of the new greenfield projects that have been in the permitting process for years are finally going to get over that hump, and we hope they do and start construction. And if everything goes according to mine plan, there will be new supply coming online in 4, 5, 6 years. That's great. If there are any hiccups with any of those projects, I think it could be a very powerful catalyst to reinforce the reality with utilities that mine supply is tricky. And even the incumbents, the best miners in the world, have growing pains and issues when they try to restart mines and expand existing ones. And, I think at the end of the day, what the producers are telling us and their clients is that the incentive price is just not there. And so let's put it in context. The uranium price right now at around, let's call it $78 a pound, seems ridiculously inexpensive to us relative to historical levels. And I say this because if we go all the way back to, say, 2011, the uranium price was around $70 back then in 2011. And, we saw a similar situation that you and I were just talking about with silver, where silver was stuck, for years and years trying to break free and surpass its old 2011 high. So when I think about the prices in uranium in 2011 at around 70 and $78 right now, it just seems incredibly cheap on a relative basis, given how much more expensive it is to mine anything in the world. So I think that's one thing. And when you look at the uncovered requirements that are building in the pipeline, so this is basically pent up future demand. It's real. And the question will become who's going to be covered and have the pounds available to them and who's going to get caught short. And we know it's always that marginal player that drives price discovery. So I think it's going to be very interesting to see if next year we get a resumption of contracting by utilities. Like I said, the last couple of months we've seen it come back to life, but we have a lot of catch up. So I wouldn't be surprised next year if we see kind of a catch up trade in the price of physical uranium, like we did in gold and silver. This year we saw kind of this catch up trade finally kind of play out.
We've talked about this in the past, and I think it's good to revisit, which is the cost of extraction or the cost of production for an existing mine. And we have a couple of big players out there. And as you mentioned earlier, they're even struggling to ramp up or to increase the volume there versus the cost of a new mine. So let's say we get this catch up trade, the new mines try to come online. What is that cost, and what kind of time frame are we looking at? Will there still be this big chasm between the supply and demand dynamics because it's taking so long for these new mines to come online? What are some of the updated numbers you're seeing out there right now with cost of production for existing versus new?
Yeah, I think it's actually creates a bit of a disconnect between the producers and the utilities. And And I'll explain myself. So if you're a producer, you want to basically promote your project and your company by saying, hey, look at the value of these deposits, look at the cost of the capital expenditure to build the mine, and then look at the operating costs, look how low they are. It's going to vary dramatically from project to project. But if you're touting you can produce uranium at $20 or $30 a pound on an ongoing basis, and you're a utility and you're seeing that, well, then you're saying, well, then the price of uranium shouldn't be much more than $80, right? I think that's kind of a naive way to think of it. Obviously, these projects are years and years and years in the making. Environmental permitting, feasibility studies, the construction. I mean, there's so many risks and hurdles and gates to get through. The reality is not every project's going to come on time in terms of its construction timeline. We'll see if when these pounds get to market. I think governments around the world are finally acknowledging that the permitting timelines and process has been too onerous, and certain projects are being identified as being of strategic or national interest and are going to get, I think, somewhat better preference. But I think for the mines in the pipeline, it's kind of a moot point because they've just spent the last 4 years trying to get environmental permits. So we will see how these projects play out. But I think it's fair to say that some uranium companies have said the current pricing environment is not supportive of building new mines. We have tier one producers tell the market very openly the uranium pricing signals and demand is not there to restart other mines that have been on care and maintenance for a number of years. So even though we have this structural supply deficit that's been in place, well understood, we still have this disconnect between responding to the future demand with a commodity supply response. It's been really, really tepid. At some point, it's going to break, and our guess is, it's going to be the utilities that blink first.
Someone's wrong and someone's right in this whole equation. And it seems like the market is recognizing that they're getting ahead of this and they're investing in the miners now, recognizing that as the price does go up, and we see this all the time in gold and silver mining stocks, that eventually, as that price starts to go up, their margins continue to expand at a very high rate.
Yeah, I think if you look at the forward curve for the uranium price, as well as look at the price floors and ceilings for long-term contracts, they are all signaling that market participants think the price is going up.
Mm-hmm.
If you think about the 3 and 5 year price for uranium forward, it's well above the spot price. If you listen to Cameco, who I think provides us the best transparency around floors and ceilings, they're now saying that the ceilings are upwards of $140 to $150 a pound and spots at 78. I mean, that tells you that the direction of travel is up. So clearly, I think there's a disconnect going on, and that the lack of activity of physical purchasing of uranium has been, I think, one of the key factors kind of holding back the spot price. The spot price to us right now feels very asymmetric. What I mean by that is it doesn't feel like there's a lot of downside to it, because if the price were to sell off, there's a very large incentive for carry traders to come in, buy in the spot market,
Mm.
sell forward a year or two or three, and make a very good rate of return on that in a risk-free way. And that's why it feels as though the price is very well supported in the mid 70s. But again, the forward curves are kind of indicating prices that are $90 to $100. And it feels as though the price wants to eventually get there.
Yeah, well, if you follow the miners, it certainly looks that way. From a technological standpoint, it wasn't that long ago that us and many articles out there were talking about small modular reactors and micro reactors really driving the future of this demand. And before we even got into existing reactors extending their operating license and new large reactors coming online, any kind of fun stats or updates you can give us on what's happening in the SMRs, the small modular reactors, and or even the micro reactors? Anything you've come across that might be worth sharing with our listeners?
Yeah, I think there's a ton of activity going on right now, and there's a lot of private capital coming into these companies. It is not going to be all players win. There's multiple designs, multiple companies. A lot of these are startups. So The market is going to sort out winners and losers here, but I think the trend is clear that this will be an emerging technology that is going to complement the large scale reactors. I think Western countries, particularly ones that have not built a lot of new capacity, large scale capacity for a number of years, are going to put their toe back in the water with a lot of these small modular and microreactor builds. Clearly, we have a number of announcements, including governments as well as hyperscalers that have made funding announcements and also very long dated power purchase agreements that are in like 20 years in duration. And again, utilities need predictability, they need certainty, they need long term contracts to make these long term investment decisions. And I think hyperscalers are bringing a lot of capital to the space. We're not going to see the first ones being operational until 2030, 2031. But I think it's like a snowball. Once the snowball starts rolling downhill, it's really going to go. And that's the same, analogy with a lot of new technologies that have to get adoption, commercialization, and then to ultimately build scale. And there is, I think, in tremendous support for doing this. I think the first ones we're going to see are actually going to be, not too far from the Sprott head office in Toronto, the Darlington nuclear power station, where they have already broken ground to build a number of these GE Hitachi SMRs. So it's coming, and obviously there are a lot of investments being made in parallel around making sure that these things have the fuel, which is another big challenge. We need to make sure we've got an enrichment capacity to provide the fuel for these investments. So that's another area I think of focus.
Well, John, as we wrap this up, I want to hit John a couple things here. As we close the book on 2025, what surprised you? And what surprised you on the upside? And then maybe what disappointed you this year when we had a lot of positive things happen in our world? Give us one of each. And then I want to get an outlook for 2026, what you think may or may not happen there, if you're comfortable with that.
Yeah, look, I think it's fair to say that 2025 was one of the most unusual years in financial markets and politics that I have ever witnessed in my 30 plus year career. It saw a lot of very unusual and unconventional developments, and we don't need to point out the primary source of those, but it was an absolute roller coaster of uncertainty and very novel, trade and tariff actions, and really a breakdown or a shift of the global order that has been in place since World War II. That is, as you think about it, an incredible shift to all capital markets, asset classes, and it had profound impact. Now, the markets have settled down, but I don't think those issues have gone away, and they will continue to flash and create flashpoints in the markets and create volatility. And I think that's the toughest thing for investors is you have conviction, you look at the fundamentals, you look at the numbers, and you say, this makes sense. But obviously, we've been in a very headline driven market this year where a single statement or a single post on social media can really set markets into a tailspin. So I think for investors that kept their conviction, it was clearly the most profitable trade of the year.
Mm-hmm.
People that got shaken out obviously got washed out at the bottom, which was unfortunate. So I do think, with respect to uranium, I think the roller coaster range bound that we were in was pretty frustrating because people are looking at the fundamentals and the numbers and saying, this just doesn't make sense. How could this commodity be lagging relative to other commodities this year when it has such a bright future? And, it's really about conviction. And we see this all the time where a commodity can go through a multi-year bull market, but along the way, there can be multiple 30, 40% drawdowns that flush people
Mm-hmm.
out. And so conviction, I think, is something very important to hold. And our conviction is completely unwavering with respect to the long-term prospects and fundamentals for uranium. I think this year was kind of a gift for people that kind of missed the earlier move I think people looked past the market dislocation that we saw in April and said, this is a really good opportunity to take advantage of this. In terms of next year, I think we're really looking for a few market signals. The contracting cycle needs to pick up to make up for lost time. There's clearly some more details the market is looking for with respect to what does Section 232 mean for uranium. This is the strategic review that's in progress. The U.S. government has made a $80 billion pledge to build a group of AP 1000 reactors from Westinghouse. Not a lot of details there, but obviously a big splashy announcement. And finally, it's going to be interesting to see if this idea of a strategic uranium reserve returns in the US and how that may play out. I think those are things that we're looking for in the first few months of 2026.
Yeah, we didn't even get into security and geopolitics. Really, we just talked about supply and demand predominantly. And you're right, that's a whole other ecosystem we could spend hours on, just talking about different countries trying to secure their own supply in order to fuel the future of their growth.
Yeah, I read a really interesting stat the other day that says that 75% of the elements on the periodic table are now considered critical materials by the US Geological Survey.
75%.
75% of the periodic table. And if you think about how much interest from a national security or energy security perspective these materials had 3 years ago, it was pretty minor.
Mm-hmm.
And so it is everything from rare earths to uranium to silver to copper. But that list, I think, is pretty telling in terms of how fixated governments are around the resiliency of supply chains when it comes to defense industries, high tech industries, AI. These critical materials, I think, are going to have a disproportionate share of focus on them going forward after largely being ignored for the last 10 or 15 years. When you look at the price charts for a lot of these metals that we're talking about, they went nowhere for 10 or 15 years. Nobody cared. There was no incentive pricing. There was no capital coming into these sectors. Nobody wanted to invest in them. And everybody was more than happy with China controlling 80 to 100% of the supply chains. Well, think about how radically that narrative has flipped upside down in the last 18 months.
That's a great spot to end this on, because that's a thought-provoking point you just made. I do like to ask, though, before we go, is there anything that you wanted to talk about that I didn't bring up? I can't think of all the great questions to ask. So is there anything else out there you'd want to leave the listeners with that I didn't bring up?
Yeah, 2025 was a banner year for most commodities, particularly the ones that Sprott is involved with. So I just really want to end with thanking our clients for entrusting their capital with us. We work incredibly hard to manage these funds. They're not easy funds to manage when you're talking about physical metals across multiple markets and types. And we take incredible pride in managing money for our clients. And it really is all about their success. And I think most of our clients had a really successful 2025. So thank you to all of them. And thank you for entrusting us with your capital.
Thank you, John. And it's been 10 fun years that you and I have been lucky to work together. And I'm looking forward to what 2026 brings for both of us and the entire firm and all of our investors as well. So thank you for that. And thank you all for listening to Sprott Radio.
This podcast is provided for information purposes only from sources believed to be reliable. However, Sprott does not warrant its completeness or accuracy. Any opinions and estimates constitute our judgment as of the date of this material and are subject to change without notice. Past performance is not indicative of future results. This communication is not intended as an offer or solicitation for the purchase or sale of any financial instrument. Any opinions and recommendations herein do not take into account individual client circumstances, objectives, or needs, and are not intended as recommendations of particular securities, financial instruments, or strategies. You must make your own independent decisions regarding any securities, financial instruments, or strategies mentioned or related to the information herein. This communication may not be redistributed or retransmitted in whole or in part, or in any form or manner without the express written consent of Sprott. Any unauthorized use or disclosure is prohibited. Receipt and review of this information constitutes your agreement not to redistribute or retransmit the contents and information contained in this communication without first obtaining express permission from an authorized officer of Sprott.